Hi, I'd like to talk to you about tactical investing, or what I like to call loss averse investing. In the industry, they call it tactical investing. My style of investing in tactical is really loss averse. But we think there's a big opportunity for this style of management. Not that it ever really goes out of favor, but to really be in favor in a big way versus the traditional strategies out there. So if there's more volatility, which we feel highly likely to occur this year and the next year, tactical investing will perform really well. It performed great last year, minimized the losses in a big way. Now with 2023 performance, it's flat to maybe up a little bit. And in 2007, 2008, 2009, it performed beautifully. 2001, 2002, beautifully. It does extremely well in down markets, but you also get a really significant part of the up move. So I've been doing this for 37 years, and I think it's a very similar pattern as we saw in '07, '08, where the Federal Reserve raises rates quite a bit, keeps them flat for extended period of time. The economy finally breaks. That's what's occurring now. The Federal Reserve raised rates quite a bit, much faster. Plan to keep them flat. Likely get a break in the economy on the downside. The market will have to come down with it. So I'm going to walk you through some charts here to emphasize this point. You'll see here in 2007, the market peaked, declined well over 50%. Subsequently, it recovered, getting back just to being even, right? Just to where it peaked out at. There was 130% return. That's what we want to achieve going forward, is protect the capital in a down market like we did last year. It'll likely occur again this year as we enter a recession, and then big recovery sometime in 24, 25, getting back to even again. Now, the decline in 2007, the peak in 2007 and subsequent decline, it took 6 years just to get back to even. You don't want to have to go through that. So if you've been to Vegas, you'll see these guys that are handicapping, basketball games or football games. And if you're at the racetrack, you see similar guys that are handicapping horses. They're really good at it, right? So as a money manager, we do the same thing. We assess the risk in front of us and the opportunities and try to place money correctly. We also use a technical algorithm to drive this whole process. But just looking at the fundamentals, 2024, the current consensus on S&P earnings is $246. We think there's about a 20% likelihood that that'll hit. So low likelihood that'll hit. In 2024, we think that it's more likely there'll be, 60 to 80% probability of being lower, and somewhere in the $225 to $235, it's probably highly likely, or it could be lower. And now we're thinking that if it's lower, it'll be at least $200 in earnings for the S&P 500. So you got 80% probability that the estimates need to be cut. We think there's a high likelihood that the market will correct at least 10% this year, if not a full-fledged decline if the earnings come in 2024 below the current consensus in 2023 of $220 for estimates in 2023. So if the estimates in 24 lower than 23, you're going to get a bear market. Now, other things to consider: recession or no recession. 80% shot of recession. And so that's not good. Kind of supports the declining earnings for 2023 and 2024 from where they are currently. Federal Reserve increasing interest rates 25 basis points at the May meeting, probably highly likely. Another 25 basis points in June, not likely. If it happens, it's the straw that breaks the camel's back. Cutting rates in 2023, 30% shot, don't think it's likely. Cutting rates in 2024. I only put 90% down here. I would call that 100% likely they're going to cut rates in 2024 because they have to. A significant financial issue in the financial sector or commercial real estate, we put a 30% likelihood on that. That's actually kind of high for that type of event of occurring. So that's not good. A debt ceiling resolution by June, maybe a coin toss. By August, highly likely. If it doesn't occur, a 5% shot that it doesn't occur, the market goes down significantly. So we default on the debt. That's a black swan event. The market's not going to like that. The market's going to go down a lot. China attacking Taiwan. We think there's a reasonable likelihood of that, maybe 30%. If that happens, another big black swan event, the market drops maybe 30%. Ukraine resolution this year, maybe 30% shot, gives you a 5% upside. Oil above $100, 30% shot, maybe that cuts the markets by 5 or 10%. Depends on how far it goes above $100 a barrel. So, two highly likely events coming this year is a correction, maybe turn into a bear market, and then the likelihood of a significant rally off the lows of 2023 or 2024. We don't know exactly, but a nice rally turn into a bull market, full-fledged bull market occurring likely in 2024. We see that as a 70% likelihood. Now, what does this mean exactly? So putting some numbers around this, current PE multiple on the S&P 500 roughly is 19 times earnings, this year's earnings, 17 times next year. If we go into a recession and earnings get cut and the estimates come down to similar to 2023, bear market occurs, the multiple of the market's too high if estimates have to come down more. Now, looking at 2025, recovery year, clearly, maybe it happens in 2024. We're looking at $246 in earnings. That's the current expectation for 2024. So it's a reasonable expectation to have. We could get back to as high as 4,700, which will be back to the old highs that occurred in 2021 and 2025. So 4 years to get back to basically where you were in 2021. Now, if we get the sort of events that we think are going to happen, 3,600 on the S&P to maybe 3,300 on the S&P. So it sets up for a really nice rally, a decline, and then a really nice rally. We want to protect our money in decline, but benefit from that rally. So if you look at a chart, okay, $246 in earnings in 2025 gets us back to the old high that occurred at the end of 2021. What if the earnings are flat this year and versus next year? Excuse me, next year versus this year. If the earnings are flat in 2024 versus 2023, we think there's a pretty meaningful decline occurring down to 3,600 on the S&P 500. So we're currently around 4,100. So that would be a pretty good size correction. Not the end of the world, but you still don't want to live through it, right? 3,300 on the S&P if 2024 earnings are less than 2023. And obviously the magnitude of that decline is really important. But that sets up for a bottom around 3,300 on the S&P 500. So earnings around $200 on the S&P in 2024, you get another bear market occurring, and that's really sets up for a very nice recovery the following year, and it sets up for a bull market in late 2024, 2025, and potentially 2026. So tactical investing, loss averse investing, very much in favor. Protect the downside, benefit from the recovery. So we expect another decline coming in the markets, and then we expect a recovery to occur. You might think, okay, why do I even care if there's a recovery? I'll just wait through it. Because last bear market, a real bear market in 2007 to 2009, down over 50%. It took you 6 years in total to get back to the high of the market that occurred in 2007. So this one is, we think, maybe 4 years in duration, but we want to benefit from the upside. So we want to benefit from this massive move that may occur that was similar to, that is similar, could be similar to 2009 going forward. So getting back to even, there's a big return potential to occur here, but we think it could extend further than that. Tactical investing, loss averse investing protects the downside, but you're still going to benefit from the up move. If the market continues to go up from here, tactical investing will go up. If the market goes down from here, you don't take the downside hit. Tactical investing is really always in style. It's always a good place to invest. However, in a down market, it's a great place to invest. You can really significantly improve your returns. Thank you very much. Please hit like, hit subscribe, go to my website, Patrick Adams CFA, and sign up for Market in a Minute. There's more stuff, Market in a Minute, that we haven't discussed that's on the hard copy. We'll send it to you directly in an email every week. Take care. Thank you very much, and we hope that this was helpful.